From a firm's perspective, the role of capital markets is to be a liquid market where firms can interact with investors in order to obtain valuable external financing resources at a low cost. From investors' perspective, though, the role of financial markets is to be an efficient market that allocates funds to their most productive uses. An efficient market allocates funds to the most productive uses as a result of competition among wealth-maximizing investors and determines and publicizes prices that are believed to be close to their true value. But how do thousands or even millions of investors determine prices that are close to their true value? Many investors attempt to beat the market by picking stocks and other securities that generate a higher return than the market average. Since all investors have access to basically the same information, it is really difficult to beat the market. Paradoxically, the collective act of investors trying to beat the market makes the market efficient. That is, the prices observed are close to their true values. But how do outsiders accurately value a business they may not fully understand, or that they don't understand as well as the experts who actually run the firms? Couldn't experts determine a price that better reflects value than a group of outsider investors? For perspective, consider Francis Galton. You may be familiar with that name if you've had a statistics class. Francis Galton was an aristocrat who believed that informed elites, such as himself, should make the really important decisions in society since most people, the crowds, were not educated, enlightened, or very smart. But Mr. Galton was a scientist and a statistician and wanted proof for his theory. He came across a contest at a local fair that suited his purposes. In this contest, contestants guessed the finished weight of an ox, that is, how much the ox would weigh after it was butchered. The individual who guessed closest to the actual weight won a prize. In this contest there were two groups of contestants. A very large group of fairgoers who were mostly poor and undereducated city dwellers, certainly not a group with any expertise in agriculture or food processing. The second, much smaller group consisted of professional butchers. To Mr. Galton's surprise, the average guess of the city dwellers was closer to the true finished weight of the ox than the average guess of the professional butchers. In fact, the average guess was a few ounces off of the actual weight. True, there was much more variation in the city dwellers' guesses than the butchers' guesses, but the crowd, on average, did a better job of estimating that value. Mr. Galton, to his credit, recognized that a diverse collection of independently deciding individuals is likely to make better value decisions than individuals or even experts. Because today's financial markets have many participants with similar incentives and similar information, the observed prices tend to be pretty close to true values. The price movements that we see in markets, here the S&P 500 Market Index, represent a crowd of investors processing new information and updating their perception of value on a minute-by-minute, hour-by-hour, day-by-day basis. And this evolving valuation process also holds for individual stocks as well. However, the existence of a few gifted investors who appear to consistently beat the market, like Berkshire Hathaway CEO Warren Buffett, suggests markets are not particularly efficient. Or is it simply that Mr. Buffett is so gifted he can beat the performance of the market? There are countless studies examining market efficiency, whether or not markets are actually efficient. We're going to discuss market efficiency in much greater detail later on in the course, but I want to quickly share the results from one of my studies in looking into market efficiency. The Wall Street Journal conducted a test that pitted the performance of stocks recommended by professional stock pickers like mutual fund managers, hedge fund managers, stockbrokers, and so on against randomly picked stocks. In this table, we show the results of the 20-year-long contest. The professional stock picks experienced an average annual return of 7.01%, and the dart picks, the random picks were selected by throwing darts at a stock listing page, experienced an average annual return of 9.12%. This suggests that markets are so efficient that randomly picked stocks do as well, or even better, than professionally picked stocks. More importantly, though, the crowd, as measured by the S&P 500 index, did better than both. So overall, it seems markets are fairly efficient. But we really like to believe that professionals can do better. Or maybe we all want to beat the market and look for hero investors like Mr. Buffett who can help us do just that. Before we move on, I also looked at how the average investor reacted when the Wall Street Journal revealed the new picks of professionals. The Wall Street Journal published new professional and dartboard picks every month. We can see from this table that the average pro pick increased in value by about 2% when the market, that is the crowd, learned of the new professional stock picks. Not everyone believes markets are efficient. Advocates of behavioral finance, an emerging field that blends ideas from finance and psychology, argue that stocks and prices of other securities can deviate from their true values for extended periods of time. Examples of the principle that stock prices sometimes can be wildly inaccurate measures of value include the large run-up and subsequent collapse of prices in the internet stocks in the late 1990s, the dot-com bubble, and the failure of markets to accurately assess the risk of mortgage-backed securities in the more recent financial crisis.